With a consistent allocation to private investments, alternative investments, and there's a lot of different flavors. Some are more defensive, some are more growth oriented. So depending on your objectives, having that appropriately sized allocation can really help in terms of reducing volatility over the long term for an overall portfolio and potentially enhancing the risk-adjusted returns of a portfolio, because volatility can really be a cost sometimes, in terms of a drawdown. And when you're really looking for that compounding of capital over time, having things like market-neutral hedge funds that are, really kind of providing that absolute return and showing, low correlations to traditional stocks and bonds, especially in times like 2022 when stocks and bonds, correlated together on the downside. Having these diversification plays helps. Even private equity, which is more of a growth-oriented strategy, has diversification benefits. I'd also say that in times of more dispersion and volatility, that's when manager selection comes into play for private markets. So it's one of those classic things between public and private markets. The dispersion of returns, the outcomes in terms of looking at venture versus large cap equity. There's a huge range of returns between the top quartile venture managers and the bottom quartile. And we see that potentially increasing with uncertainty and more winners and losers. And so you really need to be able to pick the best kind of, most skilled managers that have been through cycles to be in those top quartiles.